On September 17, 2024, the entire board of directors of the consumer DNA testing company 23andMe resigned. This comes after the founder and CEO, Ann Wojcicki, made a proposal to buy the company for just 40 cents per share, less than 5% of the value the company traded at just a few years prior. 23andMe was the first company to make DNA testing mainstream amongst ordinary people. They've helped millions of customers learn about their heritage, discover their genetic predispositions to certain health conditions, and find long-lost relatives. But they've also cumulatively burned billions of dollars trying to use their customers' genetic data to unsuccessfully find new, breakthrough medical treatments. Now, its stock price has fallen 97% from its peak just a few years ago, and is firmly in penny stock territory. The company is quickly running out of cash, and without the ability to raise new capital, it appears to be on the brink of bankruptcy. In this video, we'll uncover why 23andMe has never in its 18-year history been able to make a profit, and how its CEO is now using her concentrated voting power to try to buy the company for pennies on the dollar. A big reason we started the Wall Street Millennial YouTube channel is our belief that financial information should be democratized so individuals can have all the information they need to make informed decisions. That's why we're so excited to partner with today's sponsor, Seeking Alpha, which shares this same mission. I've personally been using Seeking Alpha for a long time before they reached out to sponsor us. Seeking Alpha is an online investing research platform where thousands of independent contributors publish in-depth fundamental research about individual stocks. Because they have so many contributors, the coverage is extremely broad, with articles covering small-cap stocks that receive little to no coverage anywhere else. For any contributor, you can look back at their track record and see how their buy and sell recommendations have played out over time. In addition to the wealth of fundamental research, for the past 13 years, Seeking Alpha has maintained a quantitative scoring system. A portfolio of the stocks rated as strong buy outperformed the S&P 500 in 12 out of the past 13 years. All of this and more is available with the Seeking Alpha Premium subscription. We've partnered with Seeking Alpha to make your decision risk-free with a 7-day free trial for new subscribers. You'll also get $30 off your first year when you use our link in the description below. And now back to the video. 23andMe was founded in 2006 by Ann Wojcicki, a biologist and daughter of the esteemed Stanford professor Stanley Wojcicki. After earning her bachelor's degree from Yale, Ann worked as an investment analyst for various investment funds in San Francisco. Alongside two other co-founders, she launched 23andMe with a bold vision: to revolutionize healthcare by leveraging the genetic data of tens of millions of people. 23andMe's main business is selling simple DNA kits that anyone can perform at home by simply spitting into a tube and sending it back to 23andMe for testing. The company then analyzes the sample and provides the customer with information about their genetics. People buy these tests because they are curious to learn about their ancestry and what health conditions they may be genetically predisposed to. Over the years, the price of these services has come down dramatically. When 23andMe was first launched, these DNA tests cost around $1,000 each. Today, you can get the ancestry-only version for just $60. Although her co-founders departed early on, Wojcicki's tenacity enabled her to secure substantial funding from notable investors, including GlaxoSmithKline and Google, whose co-founder Sergey Brin was at the time her husband. As 23andMe gained traction, it became one of Silicon Valley's most talked about biotech startups, achieving ever-increasing valuations. In 2015, the company raised a Series E funding round that valued it at a staggering $1.1 billion, officially earning unicorn status. Despite these massive investments, 23andMe has struggled with profitability. To date, the company has yet to report a net profit. The challenge lies in the nature of their business model. Once a customer purchases a DNA kit and receives their results, there's no opportunity for recurring revenue. For most users, the insights from their genetic data often lack immediate healthcare applications. The gross profits 23andMe makes from the DNA kits they do sell are nowhere near enough to cover their corporate expenses. In the fiscal year ended March 31, 2024, the company generated $220 million of revenue and $99 million of gross profit. That same year, they had $781 million of operating expenses, leading them to report an operating loss of $680 million. That loss includes a goodwill impairment of $352 million. But even excluding the impairment, the company lost more than $300 million last year. To reach profitability, they need to either massively increase their revenue or massively decrease their expenses. Over the years, 23andMe has attempted various strategies to improve its economics, but each one has failed. In 2010, they created a new subscription service, offering ongoing updates about DNA insights based on new medical research. However, this product failed to catch on and the company eliminated it less than 2 years later. More recently, in 2020, they introduced another subscription option, 23andMe Plus, which provides annual access to new reports for $70. This service also failed to make a significant impact on the bottom line. But Wojcinski's ultimate ambition with 23andMe was bigger than subscription models. Her vision was to harness the company's vast customer data for groundbreaking medical research. One of the most compelling ways to do this was to use 23andMe's customer data to build a massive dataset of genetics, then use the dataset to do research and develop new treatments. By analyzing the genetics and health conditions of millions of customers, they searched for patterns in what genetics are correlated with certain health conditions. Then, certain therapies might be found that could be effective in treating or preventing those health conditions. However, the process of developing new drug therapies is notoriously difficult and expensive. Currently, 23andMe invests around $100 million into these efforts annually, but has never successfully developed and commercialized any drug. Throughout its history, 23andMe has faced several controversies that have eroded customer trust in the company. In 2013, the FDA demanded that the company cease marketing its DNA kits to customers due to a violation of the Federal Food, Drug, and Cosmetic Act. Specifically, 23andMe had marketed a medical device without obtaining the necessary approval. The FDA had initially informed the company in 2010 that its products would be classified as medical devices. By 2013, after extensive communication with 23andMe, the FDA determined that the company remained non-compliant. The issue stemmed from the fact that their DNA tests had not undergone sufficient testing to demonstrate accuracy for healthcare-related results. The FDA was concerned that inaccurate results could pose serious public health risks. In response, 23andMe acknowledged in a letter that it had not met the FDA's expectations. Eventually, the company secured approval in 2015 and was able to resume marketing its tests. In 2023, 23andMe experienced a massive data breach that compromised the personal information of millions of its customers, which was subsequently put up for sale on the black market. The breach specifically targeted individuals of Jewish and Asian descent, with hackers selling the data for prices ranging from $1 to $10 per profile. This incident dealt a severe blow to 23andMe's reputation, as genetic and ancestry data is incredibly personal, leading to widespread outrage among customers. In September of 2024, the company agreed to pay $30 million to settle a class action lawsuit related to the breach. But the most significant challenge that 23andMe has faced is the inherently ephemeral nature of each DNA testing kit sale. Early adopters and those who are just curious about their genetics have already purchased DNA kits, and once a customer completes a DNA test, they are unlikely to buy another just for the fun of it. On the healthcare front, 23andMe's offerings have not provided compelling enough insights to stimulate significant sales. Since 2019, the market has not rebounded, and 23andMe's revenue has declined by approximately 25%, primarily due to decreased sales volumes of DNA kits. By 2020, 23andMe was running out of cash. To address this, they raised another round of equity, securing an additional $80 million. But this only extended their runway by a couple of quarters. By this point, 23andMe had raised nearly $1 billion over more than a decade, and venture capital firms were becoming increasingly hesitant to invest further. Luckily, this coincided with the Fed's stimulus-driven SPAC mania of early 2021. In June of that year, 23andMe went public by merging with one of Richard Branson's SPACs. The stock immediately surged 35% as investors jumped onto the hype, and the transaction ultimately netted 23andMe $600 million, providing Wojcinski with another 3 years of financial runway. However, this cash infusion was not a long-term solution. 23andMe needed to significantly reduce its cash burn before the funds ran dry. To cut costs, the company implemented multiple rounds of layoffs, letting go of hundreds of employees over several years. They even shuttered their in-house drug discovery division, one of their major initiatives aimed at monetizing their customer genetic and health data. They also sought new revenue streams, including the launch of a DNA-informed telehealth service. Despite these efforts, by 2024, the company appeared to be teetering on the brink of bankruptcy. According to its most recent financial filing, 23andMe has just $170 million of cash on its balance sheet, and is burning cash at a rate of $180 million annually. Even worse, their usual lifeline of equity sales is no longer an option. With a market cap of under $200 million, 23andMe is at a mere fraction of the multi-billion-dollar valuations it achieved in previous funding rounds. The company is losing more money each year than its entire market cap. With their backs against the wall, in March of 2024, the board of directors of 23andMe formed a special committee of independent directors to explore strategic alternatives for the company. 3 months later, they received a formal proposal from Wojcinski to take the company private at 40 cents per share. This price represented just 4% of the valuation at which the company went public in 2021, and offered no premium over the stock's most recent closing price. In her buyout offer letter, Wojcinski specified that she and her associates were, quote, interested only in participating in a transaction to acquire the shares of the company that we do not currently own, unquote, indicating that they had no intention of supporting any alternative sale, merger, or similar transaction involving the company. Given that Wojcinski owned 49% of the voting shares, this effectively meant that she could, and would, block any strategic option other than a sale of the company to herself. The proposal to take the company private at no premium, coupled with Wojcinski's declaration that she would block any alternative proposals, was clearly one-sided and detrimental to the company and its shareholders. Within days, the special committee responded by rejecting the proposal. They informed Wojcinski that they would allow her a limited amount of additional time to submit a more reasonable offer that would align with the best interests of shareholders. Meanwhile, they would begin exploring alternative options to restore the company's financial sustainability. Wojcinski, fully aware of her leverage, chose not to revise her offer, knowing that she could use her voting power to kill any other strategic alternatives the board might consider. Ultimately, on September 17th, the entire board of directors, excluding Wojcinski, resigned. This shocking resignation of the entire board of directors sent shockwaves through the financial media, and signaled a profound lack of confidence in Wojcinski as CEO. With Wojcinski effectively controlling the company through her 49% voting power, the board had no other options besides her lowball offer to buy the company. Wojcinski publicly responded by reiterating her belief that the company would be better off as a private entity, citing the benefits of avoiding the, quote, short-term pressures of the public markets, unquote. But what does this truly mean? She was likely referring to investor expectations that the company should take decisive actions to achieve profitability, particularly by addressing its huge cost base. In order to even approach financial break-even, 23andMe would likely have to cut research and development to near zero, massively rationalize corporate headcount, and probably slash sales and marketing as well. But perhaps more importantly to Wojcinski, it would certainly require abandoning all investment in researching new medical treatments. That's been Wojcinski's ultimate goal from the inception of 23andMe 18 years ago. Without the money to fund this research, this dream would surely die. But it's unclear how converting to a private company would provide any real benefit. The economics of the company would still be the same, a money-losing operation with a deteriorating balance sheet, completely incapable of sustaining massive expenditures on expensive medical research. Perhaps Wojcinski thinks that as a private company, she could return to the private markets to try to raise additional funds. But given that 23andMe's share price has plummeted by 97% from its peak, and its market cap has fallen below $200 million, it seems highly unlikely that any venture capital firm would be interested in investing further, especially at the valuations that Wojcinski would need to support her research ambitions. Given the situation they find themselves in, it's hard to see the current situation as anything but the end of the line for 23andMe. The best case scenario is if they somehow convince Wojcinski to cut all R&D activities, scale back sales and marketing to a fraction of its current budget, and strip down corporate overhead to the bare minimum. If they achieve this, they may be able to break even financially and at least survive. Today, the company is a far cry from the Silicon Valley unicorn that captured Wall Street's admiration 15 years ago. This serves as a reminder that every company must ultimately find a way to achieve profitability. 23andMe wasn't able to, and as a result has been cast out as just another SPAC failure from 2021. Alright guys, that wraps it up for this video. What do you think about 23andMe? What do you think is the main reason for its collapse? Let us know in the comments section below. In the meantime, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.